So in terms of the last 3 to 4 months, one of the key things we've done for Henderson International Income Trust is to issue some long-term debt, which will allow us to lock in some of the very low interest rates at the moment to fund the portfolio for a long time. It's a relatively moderate amount, but it's still, again, takes advantage of these very low rates. And that's, I think, is attractive because the actual yield on the portfolio is significantly above the cost of the debt. So even on the interest cost, you're making quite a nice spread. I think more importantly, what we're seeing is an enormous variation between kind of different parts of the portfolio. And so we've seen, what's regarded as our higher quality growth areas have got to very high ratings. And ironically, those were things 4 or 5 years ago. Many of these were stocks that people didn't really want, such like Microsoft. So we've seen ourselves taking some profit in those areas and taking advantage of the very low valuations elsewhere to add to some other areas. So we've added some stocks in Europe, but we're also seeing that there are some quite cheap areas of the US emerging. Sometimes within the more cyclical areas, but actually equally sometimes it's within some of the more defensive areas as well. So, overall, not an enormous change within the portfolio structure, but allowing ourselves to give flexibility to take advantage of dislocations in the market if they come. Yeah, from an income point of view, I would say this year we've been very positively and pleasantly surprised by the dividend trends coming from the portfolio and from the markets in general. We've seen companies generating that aren't traditionally associated with generating a lot of cash, such as the oil sectors, generating much more cash than they used to, being much more focused on efficiency. We've seen, in some cases, increased clarity from regulators around financial services. So again, we've seen some significant dividend increases from areas like the US banks. We've seen consistent dividends being paid by the European banks. And even though those share prices have been very weak, nothing within the actions of the management teams and the board's decision on dividends suggests that they're concerned. And meanwhile, other areas of the portfolio, like consumer staples and utilities in those areas, have carried on paying dividends nicely. So I'd say from the income point of view, the trends have been good across the board. In terms of particular areas of the world that are interesting at the moment, probably the most unloved areas are Europe, including the UK and Japan. We focused more on Europe. I think that's not really a reflection of macroeconomics, but more that we tend to see more kind of positive action by European companies to address the reasons that they are trading cheaply. So sometimes we're seeing conglomerates kind of splitting themselves out, breaking themselves up to try and realize value, or perhaps just to allow part of the business to run better and focus more. So we've got a number of companies like that in Europe that they're in the process of realizing value. And that feels to us that they're a bit more shareholder friendly still than Japan, but both areas, are very cheap. Yeah, the trade war is, something that, the industry, fund management industry, has not had to deal with anything like this for quite a long time. I think there's a perception, that it directly affects all parts of all stock markets, and actually it directly affects a relatively narrow area. So, for us, we've generally avoided areas like perhaps the automotive industry, where tariffs might get put on and there are a lot of products crossing borders. I think for areas like some of the consumer staples companies, telecommunications, and even in some cases leisure, in either China or in the US, you're seeing quite good domestic circumstances. You're seeing low levels of unemployment, and so actually you're seeing some interesting companies they're growing quite nicely that don't really get affected by the trade war. So I think it's been relatively easy to avoid direct impact from trade and tariffs. Longer term, the bigger question will be whether it affects the macroeconomic. And I think from that point of view, what we've done is over the last 4 months, where we are worried about trade impacting things, particularly if the share prices have performed well, we have sold those stocks and focused more on companies that are not directly impacted by the trade wars.